Today we're going to be talking about a recent paper that came out from a well-known research group talking about the biggest relative asset allocation opportunity in 35 years. Now, I'm going to break down what exactly that means, specifically asset allocation and why it's so important for long-term investors, and then what is this 35-year opportunity that they're talking about. We're going to go through two charts, and hopefully by the end of it, after a few minutes, you're going to get a better picture of why asset allocation, in particular right now, is so important when you're looking at your long-term decisions. Okay, let's dig into the first chart. So here we are looking at 7-year return forecasts from this company. And over on the left side, so the left third is looking at US companies. So you have US large companies over on the left, and then you have US large value, so larger companies that are cheaper, and then you have deep value, so very inexpensive US companies here. And then in the middle, you have international, so that's a pretty big section. So similar columns, and then over on the right, you have emerging. And so international is going to be some of your larger countries. Emerging can be potentially sometimes smaller countries or with less of a sized stock market. Okay, so as we're looking at these three areas, what you might notice is over on the very left, you see US large companies as a negative number. So what does that mean? It means this firm is looking at the current valuations, saying, okay, how much are people currently paying for companies, large companies in the US? Based on that, we think that it's expensive. And the 7-year return on average is going to be negative 1% on average for 7 years. Okay, well, how does it look for the rest of the world or even the rest of the US? Well, if you look at US larger value companies, 3, not great, but not negative. And then you can look at deep value, which means really cheap companies. You're getting about a 7% rate of return. Now keep in mind, this is after inflation. So over here where you see it says real return. So after inflation in the US, if you're buying really inexpensive companies, you're doing just fine. But if you're buying US large, or said another way, the S&P 500, there is a potential to not do as well as you might want given the current prices. And as we look over at the rest of the world, whether it's international or emerging markets, the bars look fine, right? 6%, 12%, these are all pretty big numbers. In case you're wondering what the difference is and what this little white section is, this is your potential currency return. And so when you're investing in international markets, you can make money or lose money, not just based on the price of the assets, but based on the currency. And so international has been lagging recently because the US dollar has been getting stronger and stronger. Well, when that reverses and goes back to normal potentially, those returns come back to the international markets. So that's where that number is coming from. So, okay, what does this mean when this firm is saying the biggest opportunity in 35 years with your relative asset allocation? What is a relative asset allocation? Well, let's first talk about what does asset allocation mean? Well, asset allocation means where are you putting your money big picture? How much goes into stocks? How much goes into bonds? That's your first level. And then you say, okay, within stocks, how much is going to be in US? How much is in international? And then how much is in value? How much is in growth? So these bigger picture components determine your asset allocation. And the reason that this firm is talking about the biggest opportunity in 35 years is because of this difference. So going back to the chart, with US large companies like the S&P 500, it's a very low number, while many of the other areas of the world, it's a very high number. And so relatively speaking, there's a big gap. So let's look at what this means in our next chart. So as you can see, it starts going up, it's going down, it's going back up. And so when they're saying the best opportunity in 35 years, you can look over here where we are at the very end, and it's about as high as it's ever been, which means the difference and the importance of your asset allocation is as high as it's ever been. And so I might need to unpack that a little bit. What does it mean if your asset allocation is not important, right? Because seemingly it should always be important, but when is it not very important? So let's look at when the chart is lower. So down here between, let's call it 2004 and 2012, well, what it means for your asset allocation, relative importance, to be down lower is most asset classes across the board, US, international, they're either all really expensive or they're all really cheap or they're all somewhere in the middle. And so relatively speaking, it doesn't necessarily matter where you're putting your money as long as you're putting your money in the stock market. Everything is priced-wise about the same. But if you look at now, right, that number's quite high. Also going back to, you can see at 2000. Why did it spike around 2000? Well, if you'll remember, that was the internet.com bubble. And so what happened is when you think about your relative asset allocation the importance of being not in large cap growth, which had a large period of underperformance for the next 10 years. And as you can see, it starts really high and then it starts to go down. What that number is that's growth underperforming for an extended period of time, all the way until you get to 2004. And then you can look at all the asset classes and say, well, we can just make sure we're investing and managing our fees and being diversified. But for the most part, whether we're buying international or emerging or US, there's not a whole lot of value here determining where, as just long as we're staying invested, because everything is relatively the same price. But going back to the biggest opportunity in 35 years, right? The reason that they're talking about this when we talk about a relative opportunity is you have cheap assets and you have expensive assets. And when you're buying cheap assets, it can potentially look good for future returns. But if you're paying a lot for an asset, it can lower your future return. Now, the reason that this is so important right now is, one, it's a pretty big opportunity. But where are most people right now when they're talking about the stock market? What are they looking at? Well, they're probably talking about the S&P 500. And the S&P 500, going back to that first chart, is US large. It's the asset class on the left, which means it has an incredibly potential low rate of return. Now, how do you end up with a low rate of return? You could have a big drop in the market and then it takes it a while to come back. You could just have a low rate of return for an extended period of time. But either way, what this research is showing is that you have high prices, and when you pay a lot for future cash flows, it lowers your rate of return. And so the great news here is, while this does apply to the S&P 500, for the rest of the world and almost every asset class, it looks pretty good. And so there's a huge difference, or a huge relative difference potentially in your asset allocation when you're looking at something like the S&P and the rest of the world. And so more than anything, the takeaway here is you should talk to your advisor and you should make sure that you understand, hey, knowing something like this and knowing that we have really inexpensive options and really expensive investment options, how are we allocated and why? Does it make sense? And is it aligned with my long-term plan? I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.